Our next guest suggests the market is underestimating odds of a Fed pivot. Nancy Davis is the Chief Investment Officer at Quadratic Capital Management. She runs the firm's interest rate volatility and inflation hedge ETF. Nancy, welcome to the show. Welcome back to the studio. First time since 2019. We had a chance to chat in the green room, so it's not necessarily a Fed pivot, but sort of the notion that maybe the Fed could ease off of full hawk a little earlier than what we think.
No, exactly, Melissa. The Fed has been so hawkish with their forward guidance. It's already moved the rate hike expectations. So right now, with only 4 months left in 22, we have 131 basis points of hikes priced in. So said another way, the Fed has to hike 131 basis points just to meet expectations. So if they
Okay, now I would agree with what she's saying partially, right? I think that there is a chance that the Fed is going to be a little bit less hawkish, and I tend to be on that side most of the time because the Fed realizes that the markets are, at the end of the day, important to a lot of the people in the country and to the companies that operate in the country, and they don't want to see those markets decimated, which they got a very clear message when they said that they were going to be very aggressive with their interest rate hikes. They got a very clear message where they saw stocks begin to tank, and it hasn't really ended since that point. All right, that's markets essentially telling them that there's not going to be a massive rally if they're going down this very aggressive path. Now, the Fed is currently looking at a situation where their interest rate hikes and other things that have been going on have actually led to a small decrease in inflation. And overall, if they can continue to see a trend like that, I don't think they're going to want to continue to decimate markets. They obviously want to influence markets with both their policies and their rhetoric, though. So it makes a lot of sense why they would be saying that they're going to be raising rates more than they might actually when it comes time to do so.
hike, say 75 or 50, and then another 25, that would actually be perceived as less than what's priced in right now.
So what do you make of the extreme, maybe extreme is too extreme of a word, but the elevated interest rate volatility that we were just talking about, the VIX being so muted, but yet interest rate volatility has been high. And I'm wondering, in past periods, have you seen this? What does this sort of portend?
Well, I think it makes a lot of sense because we have quantitative tightening. Just starting tomorrow, we'll be into September already, and the Fed is going to be doubling their caps and reducing their balance sheets. So quantitative easing was the Fed buying on the SOMA holdings and increasing, buying treasuries, buying tips, buying mortgages. Now they're going to be reducing that, and with the caps doubling, I think it's logical that interest rate vol is on the uptick right now.
Okay, so when the Fed ends up doing this quantitative tightening, and for anyone who doesn't know, the quantitative tightening is essentially the Fed looking at their balance sheet and ending up getting rid of the assets on it and taking cash back in, which in effect should strengthen the value of the dollar. Now, what a lot of people aren't paying too much attention to is that the Fed, or that the dollar, is already getting fairly strong. In fact, the euro just hit parity with the dollar for the first time since 2002. Now, while it doesn't look great regarding inflation, the fact that the euro and the dollar are on par at least means that the dollar is doing better than some other currencies like the euro. Now, typically, for those of you who are unaware, the value of a dollar versus a euro, usually you have to spend maybe $1.30 to get 1 euro. But when they have a parity, it actually means that you can do a one-for-one trade for them. And this is a rare occurrence. Typically, the euro does have more value than the dollar, but that's not the case right now. The Fed's dollar is actually doing pretty darn good at the moment. And while they will probably be engaging in more interest rate hikes and trying to maintain that strength and to continue to bring down inflation, it's not necessarily something that should be on the highest priority for them when they see that the market is moving down pretty rapidly in response to these decisions. I think that they're not going to be as hawkish as they ended up saying they would be.
Hey, Nancy, it's Jeff Mills. Just two real quick questions. So I was asking this yesterday to our research team and, pondering how many hikes, where do we end? How much does it matter at that point if we're recession bound already? Has what the Fed already done,
talk about recession bound already. I want to point out to you guys that we have already seen 2 consecutive quarters of GDP shrinkage. And that does mean, the old definition, at least, of a recession was that there would be 2 consecutive quarters of negative GDP. And unfortunately, it looks like they've tried to change that definition a little bit. They've tried to finick with it and make it look like we're not in a recession. But according to my book, at least, we are in recession already. So this guy, he doesn't want to admit it, but I think a lot of people realize we're already in a recession. Now, how long it will last, I don't think too much longer. Hopefully, we'll see.
Is the writing on the wall? Are earnings already going to come down? And does that then seal the market's fate here? And then, in the same breath, where do you want to go in the market in that environment?
Well, the rates market is definitely pricing in this recession, slow growth. You can see that with the massively inverted yield curve. The level of 5-year break-evens is just barely above the 2% target. So even though the Fed might have retired that dirty word transitory, the rates market has not. So the rates market is definitely pricing in a disinflationary, slowing inflation growth. Actually, low growth, maybe even recession is priced in. But the equity markets and credit markets are still, even though we've had a little bit of a pullback right now, they're still doing pretty well. So I think the question is, which market is going to be right? Because we really have two different stories going on, whether you're looking at corporate America versus the government bond markets.
Now, it's a tough thing to say which market is going to be right, but I do have a feeling that a market that's probably going to be wrong, at least this time for now, is the stock market. The stock market does tend to overreact to these kinds of negative stimuli. It does tend to go very low very quickly. And right now, I think we're in one of those overreaction phases. I think that we're probably going to see big appreciation in prices in a relatively short period of time, as soon as people wrap their heads around the idea that there will likely be growth for many years to come. I think that once people start seeing that growth come back and they're in a bit of a less fearful mode, they'll start to buy up stocks again, and we'll start to see more stabilization occur. Right now, we are, looking at a lot of, unfortunately, very tumultuous times for the world. There is a war in Russia and Ukraine. There's a potential war brewing between China and Taiwan. The Fed is raising rates. There's a lot worrying people right now, and I think that's caused a lot of stocks to become oversold. And this is just a chart of the S&P 500, the index, and even this has become very oversold. It's even more true of smaller market cap stocks. And that's just my opinion, guys. I just wanted to bring some of these issues to light and show you guys an interesting video that I found and respond to it a little bit. So if you guys appreciate that, feel free to subscribe to the channel. Obviously, keep in mind, none of this is financial advice. And other than that, I hope you have a great rest of your day. I'll see you in the next one. Bye.